new data from Statistics Canada today shows overall inflation continues to edge down, largely driven by a decline in the cost of gasoline. But food prices at the grocery store continue to rise. The overall rate, now stands at 2.3%, down from 2.4% in December. Analysts had expected that rate to hold steady. And as I mentioned, I think just before the commercial break, food prices were up 4.8% in the month of January. Former Bank of Canada Governor Steven Poloz is here. Mr. Poloz is a special advisor at Osler, Hoskins and Harcourt. Hi, Mr. Poloz. Good to see you.
Great to be here.
Thank you very much for making the time. I wanted to start off on that overall headline inflation number.
Yeah.
What is your read on it? Feels like it's in a better place than it has been. Maybe?
Yeah, I would describe the report as a benign report, which is, in a way, good news because you're in a context where we're worried about some upside risks on inflation coming from the tariff disruptions to trade and how companies adjust to those things. I think those risks remain, but it's in that sense, it is a positive outcome that we're still where we were or even a touch lower. But underlying inflation, I think, is still in that sort of 2.4, possibly 2.5 or 2.3. It doesn't really matter. That's not a horrible place to be. And what we're seeing is plenty of evidence that the economy has still got excess capacity and probably a little bit more excess capacity as we go forward.
What does that mean in layman's
Well,
terms?
that means that there's slack in the economy. We've got jobs being lost in some of the targeted industries. We're going to see some jobs being lost in the public service and so on. So there's some downward pressure on inflation that comes from that slack in the labor market. And it's modest, but it's still present, and it's likely to give this general tendency for the inflation to edge lower unless something goes wrong, and something that goes wrong might be an uptick because of the trade disruption or something like that. Yeah.
What does that mean, do you think, moving forward for interest rates?
Well, I think we're in that, it's even more complicated than I just said from that point of view, because some of the slack would be labeled as structural, that is coming from the change in the trading world that we live in. And that's a sort of shock to the economy that interest rates can't really address. If you've seen the Bank of Canada be pretty clear about that. And in fact, a large share of the job losses we've seen are in those sectors that are the Trump's targets. And so what that means then is there's not much that one can do about that except do the kinds of things that the government's announcing, like around defense procurement and those kinds of things, to create jobs in other areas, or perhaps jobs from other areas that impact, say, steel or aluminum, those kinds of things. So I think in the end, those structural things take more time. The context you're thinking of, though, is like uncertainty is so high. Yeah. Investment is very weak. Household spending is not that strong. In fact, consumer confidence is kind of at recession levels. And so we're in a place where the economy doesn't have a lot of pep, in that situation, and downside risks can show up at any time. So in that context, inflation should be easing lower, but do interest rates come in to kind of correct that? That's much less likely when those structural issues are happening. At a point in time, you won't know which is dominant, but we'll know if inflation continues to fall, that means that the gap, or as we call it, or the excess capacity is actually increasing.
I have more questions about the structural issues, but I did want to ask one more question about inflation.
Yeah.
And not for you to weigh in the politics, but it is a politically contentious subject.
Sure.
And it is actually, I think, something that matters a lot to people, and that is the cost of food, right? Which, keeps outpacing the headline number that we're looking at quite substantially in the past few months, for example. What is going on there, in your view?
Well, those numbers are, of course, being affected by the tariffs that were put in place in a number of food areas. They're also being affected by the taxation effect that came through, which was, the tax holiday and then the reversal of the tax holiday. But I think the big thing is that the whole food sector is suffering from a variety of what we call special shocks, such as the prolonged drought that we've had in Western Canada and the United States, unfortunate weather in other parts that, just sound like special things. Well, they affect prices, and it could take a whole year for those, or more, perhaps, for beef, for example. It could be a very long cycle for beef to recover from a prolonged drought that we've had. And that especially affects, as you know well, like not just home groceries from the grocery store, but also restaurant meals. And so you kind of have this broad swath of costs that are rising all at the same time. And certainly that's got nothing to do with the cycle in the economy or anything. That's why when we look at inflation, we usually talk about, core inflation or something that excludes gasoline or energy and food, because those are things we really have no control over. And if we do that, we kind of get to that 2.4% area, which suggests inflation is just a little higher than we'd like it to be, but not really significantly so.
When you look out over the near term to midterm, and in particular around the degree to which uncertainty with the United States has impacted things that you mentioned, like inflation, investment, growth, things of that nature. We have this sort of thing hanging over us over the next 6 months to a year around the review of CUSMA. The bank has obviously referenced some of the uncertainty that creates. How do you think it will translate, in particular to growth or lack thereof?
So I think the economy, most economists have sort of settled in on around a 1% growth track, which is kind of a resilient but not great growth track. I would say to that, I'd add another downside risk, which is that oil prices, we used to think of 80-ish, and now we think 60-ish. Well, that's 3 to 4% of our economy with a headline reduction in revenue growth of something like 20 to 25%. So it can take 1 percentage point off of economic growth right there. So I kind of think 0-ish is more our track. But anyway, somewhere between 0 and 1 seems to be where we are. And that just means that you're in a place where at any point, anything that's negative is going to throw you off into recession. Now, on the other side of that balance sheet is, of course, initiatives that the government is taking, which we can't really estimate how quickly they're going to come in, as you were just talking about just a moment ago. Well, but we do have the GST credit went up. That's going to impact right away. Some of the defense spending is immediate. So there are some things that are actually going to be offsets in that picture, but very hard to time or measure. So I think that just underscores that we really are in this kind of in-between space, what gray zone, which the bank has called, risk management zone. There's no clear trajectory one way or the other, and you're going to have to see the data to decide what's next.
Do you think a resolve, should there be one, and obviously, best case scenario, there is some sort of resolve, even if it isn't the perfect deal, but just an actual deal that both parties say, we want to endorse. Do you think that that will actually provide the kind of certainty to change that trajectory, given the evidence of, the fact that the deal existed before and it didn't mean that much? Like, will it actually create certainty is my question.
Yeah, I'm a little reluctant to stick my neck out on that. I certainly think it's bound to reduce uncertainty. And for sure, if you're in a sector that has not been highlighted as one of the president's target areas or in a related sector, then I think having CUSMA restored or ready to keep on going would make a big difference to a lot of companies. And companies that for right now have been operating under CUSMA like that. So everything's been going okay, but of course the uncertainty is kind of killing them, and they're holding back on investments. So I think there's going to be some unleashing of animal spirits when there is certainty, even if it remains uncertain in those, let's call them strategic sectors that the president always highlights. And I'd like to remind people that the list of things that he cares most about add up to about 2% of our economy, which is not zero. That's a pretty big number in any day. And yet we do know that the capability of Canada to replace up to 2% is right there. Okay, just the critical minerals business, the defense procurement, you're talking about 100,000 or more jobs. That's meaningful in that impact space. The energy plan that Ontario's putting in place. Those are a lot of jobs that will be created. And so we have to bear in mind that there are things going on that will allow companies to pivot, certainly employees to pivot.
Okay, I'll leave it there. Thanks a lot, Mr. Poloz. Appreciate the analysis as always.
My pleasure.
Steven Poloz is the former governor of the Bank of Canada.